Welcome to Power Wealth. For months, you've watched your crypto portfolio bleed exactly at 10 a.m., thinking it was just bad market luck. It wasn't. Today, a massive legal filing just forced the biggest market makers on Wall Street to turn off their algorithms, and suddenly, the market is exploding. The manipulation lid has been lifted. If you want to know what is actually happening behind the order books, you need to pay very close attention right now because the game has fundamentally shifted. For weeks, the clock struck 10 a.m. and the market bled with surgical precision. Today, there was only silence. XRP has reclaimed $145, surging 8%. But the real story isn't the price action. It's the sudden, suspicious disappearance of the Jane Street liquidity dumps. The 888 Bitcoin lid that artificially capped every single recovery has been removed. I am the calm analyst, and on this channel, Power Wealth, we do not chase hype. Today, we decode the legal cease and desist effect on market manipulation. We analyze the massive circle earnings explosion that just caught Wall Street completely off guard. And we evaluate the critical strike 3 crossroads waiting for us at the 1348 EMA. Are you just celebrating the green candles, or are you watching the institutional chains being clinically cut? Let's dive deep into the forensic data. The most profound piece of evidence in today's rally is not what appeared on the chart, but what disappeared from the order books. For months, we have clinically tracked a recurring, surgical sell-off occurring every single day at exactly 10 a.m. Eastern Time. This pattern, dubbed the Digit 10 phenomenon, was explicitly designed to front-run retail liquidations and hunt stop-loss clusters with asymmetric precision. Why 10 a.m.? Because that is exactly 30 minutes after the traditional stock market opens in New York. It is the window when global liquidity is at its highest, making it the perfect smokescreen for algorithmic market makers to dump inventory without causing immediate panic. Retail traders assume it is just institutional profit-taking, but the forensic data tells a different story. It was a coordinated extraction of wealth. Today, after a high-profile legal filing against Jane Street alleging market manipulation, that execution window remained closed for the first time in recent history. To understand how massive this is, you have to understand how algorithmic suppression works. Forensic observers have noted a recurring suppression tactic for over a year. Every time Bitcoin attempted to reclaim a key level, a massive block of exactly 888 Bitcoin would suddenly appear on the ask side of the order book, effectively capping any recovery. This is a tactic known as spoofing. The order is never meant to be filled. It is placed there to create an illusion of massive supply, terrifying retail algorithms and human traders into selling their positions before the imaginary wall falls on them. The moment the price backs away, the 888 Bitcoin order is canceled. It is psychological warfare executed by machines in milliseconds. To give you empirical context, spoofing was explicitly outlawed in traditional markets under the 2010 Dodd-Frank Act, following the infamous flash crash. The Commodity Futures Trading Commission, the CFTC, has fined traditional banks billions of dollars for this exact behavior in the precious metals markets. Now, that same regulatory microscope is being pointed at crypto order books. Today, that lid was clinically removed. The sell-side order books on Bitcoin USDT have completely flattened, heavily suggesting that the institutions responsible for this suppression have entered a tactical cease and desist phase. When a major legal filing hits the wires, the first thing a Wall Street compliance department does is pull the plug on the high-frequency trading desks to prevent further liability. While their legal teams evaluate the fallout, with institutional tactics officially on trial, firms like Jane Street, Citadel, and Jump Trading have long held an unfair edge over retail by using sophisticated algorithms and insider-level order flow data. They see your stop losses. They see your leverage. They calculate exactly how far they need to push the price down to force your broker to liquidate your account. Pause and let that sink in. The lawsuit claims these exact firms were instrumental in engineered events like the Luna crash and the massive October 10th liquidation cascade. By pausing these practices today out of legal fear, the market was finally allowed to seek its natural equilibrium. This abrupt lack of engineered sell pressure is what allowed XRP to instantly surge past resistance to $145. But we must maintain clinical perspective. While XRP being up 8% is a massive victory for sentiment, we are still far from the $2 level seen before the Coinbase withdrawal from the Clarity Act. The market has bled for weeks, and this recovery is essentially reclaiming the ground lost to institutional shenanigans rather than a genuine new all-time high attempt. The suppression was the ceiling. The lawsuit is the hammer that shattered it. Are you chasing the green candle, or are you watching the forensic flattening of the order books? Because while the Jane Street silence provided the opportunity, the Circle earnings report provided the clinical, undeniable justification for this rally. Circle, the powerhouse behind the USDC stablecoin, has officially shattered Wall Street expectations in a market climate that many mainstream media outlets described as harsh, uncertain, and dying. They delivered a blowout report with $770 million in total revenue, significantly topping the analyst consensus of $745 million. Let me explain why this specific earnings report is the most important piece of fundamental data we have received this year. Stablecoins are the plumbing of the digital economy. They represent the actual fiat liquidity sitting on the sidelines, waiting to be deployed into assets like Bitcoin, Ethereum, and XRP. The global stablecoin market cap has recently pushed past the $150 billion mark. When Circle reports $770 million in revenue, it proves the infrastructure of the digital economy is scaling aggressively, despite the brutal price volatility we experienced over the last few quarters. This is not retail money buying meme coins. This is institutional capital utilizing blockchain rails for cross-border settlement, yield generation, and capital preservation. Look at what is happening with BlackRock. The world's largest asset manager launched their BIDL fund, a tokenized treasury fund that operates heavily through USDC integrations. Traditional finance is not just looking at crypto, they are actively building their future settlement layers on top of it. Perhaps the most surgical data point in that Circle report is their reverse income, which surged a staggering 77% year over year. Traditional regional banks are struggling to maintain deposits, yet a digital asset infrastructure company is seeing exponential revenue growth by simply holding treasuries and issuing on-chain dollars. When primary stablecoin issuers show this level of explosive health, it signals to institutional OTC desks that the liquidity rails are not only stable, but highly profitable. It removes the existential dread that mainstream media tries to push regarding the death of crypto. The money is not leaving the system, it is merely resting in stablecoins, generating risk-free yield from the US Treasury, and preparing for the next massive deployment. Simultaneously, we are witnessing one of the most violent short squeezes in recent history playing out in the equity markets, which is spilling over directly into crypto. MicroStrategy recently became the most heavily shorted stock among US large caps. Traditional hedge funds looked at the premium MicroStrategy was trading at compared to its underlying net asset value, its actual Bitcoin holdings, and assumed they could arbitrage the difference by shorting the stock. This was an act of profound institutional hubris. They completely miscalculated Michael Saylor's capital allocation strategy. MicroStrategy doesn't just hold Bitcoin, they issue billions in convertible senior notes at sub 1% interest rates to buy even more Bitcoin, creating an infinite fiat to crypto feedback loop that breaks traditional valuation models. The combination of the Circle earnings confirming fundamental strength, the removal of the 888 Bitcoin algorithmic wall, and renewed Bitcoin inflows created a pressure cooker effect. When the market started moving up today due to the removal of the algorithm lid, those hedge funds were trapped. It sent MicroStrategy shares soaring 33% in a single day. To understand the mechanics of this, you must realize that a short squeeze is not natural buying, it is forced buying. When you short an asset, you borrow it and sell it, hoping to buy it back cheaper later. If the price goes up instead, your broker issues a margin call, forcing you to buy the asset back at any price to cover your position. This forced buying creates a violent vertical price spike. This massive liquidity event forced short sellers to capitulate, creating a secondary wave of buy pressure that pushed the broader market, and specifically high beta assets like XRP, even higher. This is what we call a double engine recovery. Engine 1 is the sudden removal of algorithmic institutional suppression due to regulatory and legal threats. Engine 2 is concrete, explosive financial performance from sector leaders combined with forced short covering. At 1:30 p.m. today, when these earnings hit the wires and the short squeeze accelerated, XRP jumped another 6.75% almost instantly. The market has been starving for fundamental truth, suffocating under synthetic algorithmic pressure. Once it found that truth, the reaction was absolute and undeniable. The earnings are the fundamental floor. The short squeeze is the violent propellant. But as the calm analyst, I must warn you about what comes next. We are now approaching a critical, make-or-break junction on the 1348 exponential moving average. This is a technical boundary that has historically acted as a massive, impenetrable rejection wall for this market. Why the 1348 EMA? This isn't a random technical indicator used by retail day traders. This is a specific, long-term Fibonacci-based moving average heavily utilized by institutional quantitative models to define the absolute boundary between a macro bull and a macro bear market. Institutional TWAP, time-weighted average price, and VWAP algorithms are programmed to defend this line at all costs. We have seen this play out twice already in recent months. Each time we touched it, the market was violently slapped back down, creating massive pain for anyone who bought the breakout too early. We are now at the threshold of the third attempt. If Bitcoin can creep past $70,000, absorb the institutional sell pressure at the 1348 EMA, and maintain its footing, we may finally see the crossover that confirms a permanent macro trend shift. However, if history repeats itself, this could be strike three. A third rejection here would be devastating, leading to another clinical, multi-week correction toward the lower ranges to flush out the late buyers and reset the funding rates. This is why we must look at the full spectrum of data and not just the intraday green candles. While the short-term moving averages and oscillators have finally turned blue, indicating short-term bullish momentum, the medium-term 30-day and long-term 50, 100, and 200-day averages remain firmly in the red. This color-coded reality is vital. This divergence suggests we are currently in a neutral to bullish pocket within a broader, overarching bearish structure. It is a relief rally inside a larger downtrend until mathematically proven otherwise. Because of this specific market structure, there is a dangerously high probability that retail traders are about to over-leverage into this rally. As the algorithmic lid is removed and prices surge, human emotion takes over. The fear of missing out kicks in. Many will chase this upward move using 10x, 20x, or even 50x leverage, desperate to make back the money they lost during the weeks of bleeding. By doing this, they are actively creating a brand new cluster of long liquidations. They are building a pool of liquidity that market makers, once their legal teams give them the green light, will inevitably hunt. A continued short squeeze to the upside is entirely possible, but so is a violent forced reset if the market fails at the EMA crossroads. Furthermore, we cannot analyze this market in a vacuum. We must address the geopolitical monkey on our back. We are currently navigating escalating US-Iran tensions and a deeply fragile macroeconomic landscape. We are watching the US dollar index, the DXY, very closely. Historically, Bitcoin and XRP operate in an inverse correlation to the dollar. When the dollar shows strength, risk assets bleed. While today's market sentiment is heavily buoyed by the Circle earnings and the pause in Jane Street's algorithmic suppression, a single geopolitical headline, a military escalation, or a sudden hawkish statement from the Federal Reserve regarding interest rates can flip the global fear and greed index back to extreme fear in a matter of minutes. Crypto does not exist in isolation. It is the ultimate high beta asset class. When global liquidity contracts due to fear, crypto is the first thing institutions sell. We are trading in a highly reactive, news-driven environment where technical analysis provides the map, but macro events provide the weather. And a storm can invalidate the best-drawn map. So, how do we navigate this? To declare a true, undeniable bull market, we need to see strict, forensic conditions met. We need to see XRP reclaim and hold the $2.50 level with high volume, firmly establishing it as a new base of operations rather than a speculative wick. And we need to see Bitcoin decisively break and stabilize above $100,000, turning previous historical resistance into unbreakable support. Until those specific forensic levels are met and held, every rally you see is a high-risk pocket. It is a battlefield that must be navigated with surgical caution, not reckless emotion. Do not be the liquidity that market makers hunt. Do not hand your capital over to institutions because you couldn't control your impulse to press the buy button on a green candle. Lower leverage or strictly spot positions are the only clinical mathematical ways to survive this level of systemic volatility. Finally, I must issue a strict imposter warning. In times of high market volatility, when hope returns and prices pump, the scammers emerge in full force. Remember, I will never contact you on social media, Telegram, WhatsApp, or the comment section asking for your money, offering to trade for you, or asking you to sign up for an exclusive VIP program. Any such contact is a malicious imposter seeking to exploit your optimism and steal your capital. The only place I provide this analysis is right here on Power Wealth. The momentum we are seeing today is a gift, but your strategy is your shield. The artificial lid has been temporarily removed, but the macroeconomic ceiling remains heavy. With the Jane Street lawsuit pausing the suppression algorithms and the Circle earnings proving the fundamental underlying strength of the digital economy, we currently have the most massive tailwinds we have seen in months. The double engine is firing. But remember, market sentiment can flip in a heartbeat. The institutions are wounded, but they are not dead. They are merely regrouping. I am the calm analyst. Stay clinical in your execution, stay forensic in your research, and above all else, stay patient.